If you and your spouse are struggling in regards to how aggressive or conservative your investment assets should be, you're not alone. This is a common thing that I come across. Now, there's nothing wrong with this. Each person naturally has a certain disposition. Some personalities are more okay with taking more risk than others. Moreover, we each have personal experiences about money. So both the natural disposition and the experiences we have are going to shape our perspectives. And because each person is different, we're each going to have different perspectives about the how we want our funds to be invested. Now, we cannot stop here. If we stop here, there's just going to be ongoing conflict between the couple. So I'm going to take you through some of the steps I take when I work with couples and how we can transition this piece of this point of tension to be positive and constructive in the overall conversation surrounding money. The first thing that we need to do is acknowledge and identify the disagreement. When it comes to investment risk, oftentimes one spouse is going to be more conservative than the other. And that is, again, totally okay. Because it's out in the open, we can work through it. And honestly, it is not about who's right and who's wrong. It's about understanding where each person is coming from and giving both partners a voice in the conversation. The next thing we need to do is establish shared goals. And when I talk through this, oftentimes spouses are on the same page and what they want their future to look like together. And when we establish this and we're clear on what we want their money to accomplish, now we have a foundation and an anchor. The next thing we need to do is understand risk and how it'll impact the different portfolio allocations, and moreover, how these individuals are oriented to behave when there is a significant market downturn. When we walk through understanding downturns with a conservative, moderate, or aggressive investment allocation, it helps people understand the range of potential outcomes with the different portfolios. This process is eye-opening, not only because it shows the downside, but it also shows the long-term upside potential and whether or not the growth within each of these portfolios is sufficient to help them accomplish their long-term financial goals. And so through this process, we can identify the different trade-offs and how much growth we might be giving up for peace of mind and how much volatility we're accepting for the potential of long-term stronger returns. Going through this process really helps set the stage and really helps move the conversation forward. This next step is crucial. Let's talk about behavior. And let's be honest, the markets are going to go up and the market's going to go down. And it's a matter of what you do when things get tough. When we look at how each of you is likely to react during a market downturn, would you feel the urge to sell? Would you feel the pressure to shift to cash? Or are you comfortable with staying the course? A plan will only work if both people can stick with it. So sometimes we blend strategies. Sometimes we create a core conservative base to provide peace of mind and a satellite growth portion of the portfolio to satisfy the long-term needs that the couple needs to achieve. That way, both partners feel heard and both risk tolerances are respected. So in conclusion, disagreements about money and risk don't need to divide you. In fact, they can bring clarity and unity when approached the right way. It's about listening and understanding the trade-offs and building a plan that reflects who you both are and where you want to go and what you want your future to look like. So thank you so much for watching. Please like, subscribe, and we will see you in the next video.